Hi, everybody, and welcome back to EBnet.Stream. Today is the day that tariffs take hold and are implemented. And I thought I'd reach out to Bastian Teichgreeber, the Chief Investment Officer at Prescient Investment Management, to discuss the implications and the effects of these tariffs for us in the retirement and investment space as asset owners and asset directors. So welcome to EBnet.Stream, Bastian.
Thanks for having me on, Natalie.
Okay, so let's start maybe from the point of view of, we understand that everybody's been kind of socialized on tariffs, but maybe let's start from today's the day. It's day one, effectively. What can we expect from today?
I think if you look at financial markets, Natalie, you really wouldn't expect too much. This has been, unfortunately, long anticipated. And if you look at capital markets today, you'll see that it's a non-event. We knew it would be coming. I think we missed our deadline on the 1st of August to really negotiate a deal. It now hasn't happened. So for it to be resolved over the last couple of days is unlikely. And then you can see that markets are taking it easy. And we've got a strong rand, we've got strong bonds. Not a train smash, but I mean, capital markets are efficient. So with that, you wouldn't expect a big reaction from capital markets today.
Okay, so I get that, and I understand we wouldn't have had or aren't expecting a massive impact today, but there are consequences and impacts over the long term of this. And the article that I received from Prescient talked about this Trump tariffs possibly sparking a new wave of global inflation or risk aversion. And so perhaps we can delve more into that and your thoughts around, could they?
Yeah, most definitely they could. Look, I don't want to underplay the importance of tariffs and the impact thereof on capital market. It's big, and it's particularly big for a country like South Africa because we are part of the emerging market set, so to say, subset, so to say, if we look into capital markets. And with that, small but open economy like South Africa, you are subject to the ebb and flow of where the money is going, right? So if money is coming into emerging markets, we'll benefit. If money is leaving emerging markets, we will, take some pain. And the reality is that whenever there's more tariffs, whenever there's more of a risk-off event, as we call it, then money will rather leave the more risky spaces like emerging market bonds, emerging market equities, and also will basically flow away from the carry trade locations like South Africa. So with that, I did not want to underplay the impact of these tariffs, but I do think that obviously today you won't expect a big reaction because we knew it would be coming.
Sure. What should an investor be looking out for? And my real question that I really want to ask you is, should I be taking all my money offshore or take it all up to the 45% that I'm allowed to through my obviously my institutional retirement fund money? But what should I be looking for? Perhaps you can guide some of us as kind of more layperson investors.
Well, first of all, you need to look at your portfolio and make sure that it's broadly diversified, right? So you can't just now deal with a certain scenario and position for that. That's not how you should be building portfolios. You should be building portfolios which are robust through any cycle and which can easily navigate the storms of such a political event and such a political environment. And that's what we do at Prescient. What it means in detail is, yes, you shouldn't be 45% offshore because 45% offshore means that you still have 55% locally. And we are quite positive on South Africa. We think we've got a great universe of assets. We've got a lot of undervalued asset classes, and very high real yields, which we can easily earn here in the rand space. But just be aware that, as I said in the intro, we are a small open economy. We are subjected to the flow and the ebb and inflows of capital. And with that, you do want to diversify. Nothing goes past that. And for that, you need to have money offshore. So being risk cognizant, building portfolios which are robust through any scenario, that's what you have to do, and that's what you should opt for. But then you need to look through the noise. Don't stress about the tariffs hitting on markets today. We've anticipated well in the long in the price, but nevertheless, have a smart and well-diversified portfolio.
So we say don't look out for it today. What is the timeline that we should start seeing some impact?
Yeah, you will see impact, and you see impact already, right? So, and I'm not just talking South Africa, I'm talking like more the global economy. There's quite a marked slowdown, which we can track since we see the tariffs being announced, not just the tariffs towards South Africa, which on a global scale arguably is small, but generally the more aggressive stance from the Trump administration on trade in general. That is problem for global trade. It means it's a big problem for the global economy. It means there's just a slowdown, and that global slowdown will have an impact on global capital markets. You can hear that I'm not using the word recession, just talking about a slowdown. Those are two different things. But a slowdown can turn into a recession, and that's what we're keeping the eyes open for, because that's the biggest risk now, that we have basically very high interest rates, tight financial conditions, and now marry that with a lack of business confidence, a lack of investor confidence, because we're slapping on tariffs. That can obviously be a dangerous cocktail, and that's exactly what we're measuring and looking out for every single day.
EBnet is proud to bring you top quality content from experts across the financial services industry in South Africa and internationally for free. Your support helps us in doing this. All we ask is that you subscribe to our channel by clicking the subscribe button below. Share this video with others you think will benefit from it, and give us a thumbs up if you are enjoying the content. That way you help us help you. Thank you from the team at EBnet. For more great content, please visit www.ebnet.co.za.
I hate to polarize things, but in my opinion, or in my mind, I describe or think of tariffs as bad. It's bad for our local economy. It's bad for growth in our economy. Is this a no turning back scenario? I mean, if at some point the politicians want to get back around the table and have a conversation at the White House or locally, could we reverse this?
And I mean, if you look at the pace at which the Trump administration is moving, everything appears to be removable again after it has been put in place. The reality is that the White House is following a certain trade agenda. So what they're trying to do is I think they are trying to achieve two things. The first is they want to improve the terms of trade, meaning they want less imports into the United States and more exports out of the United States. And the second thing is they also have a quite large budget deficit, which they want to now kind of like fill by raising revenues through tariffs. I think both arguments are poor. I think tariffs, as you said, and as you suggested, I think you're spot on. Tariffs are a bad thing, and I don't think it's too polarizing to say that tariffs are an inefficient way to raise revenue. Tariffs are bad for global trades, and tariffs are only creating friction. So I think there's no winner in this. There's only losers. The biggest loser, interestingly, being the United States. But the Trump administration seems to be happy with that, as long as they can achieve the purpose which they want to achieve, which is a better trade balance and potentially raising revenues through tariffs. Remember, the tariffs are not really paid by foreigners. The tariffs are paid by the US consumer. So that's something we need to bear in mind.
Exactly what I was about to say, right? So you mentioned that it's actually not good for the US consumer because it just makes his bottle of wine from Stellenbosch more expensive. So yes, we may be looking at the macros, but at household level in the US, not such a great thing.
Not such a great thing. So we do think that there's might be a small push for goods inflation, and that it's potentially elevating inflation in the States on a shorter term outlook. We're not too worried actually about that inflation impact over the short term. Yes, over the long term, we think it's not going to be very inflationary. So the consumer price index or the basket, or whether goods in the States become ever more expensive, we don't think that's what's going to happen. What we do think, though, what's going to happen is that things become more inefficient for US corporates and for businesses in general. And with that, we do track a slowdown in economic growth in the United States, and that's what the consumer will eventually also feel, because less economic growth means less wage growth, which means less money in the pockets of the consumer. So we're more worried about the economic impact from a growth point of view than the economic impact from an inflation point of view. So in a nutshell, what I'm trying to say, less worried about inflation, but yeah, most certainly worried about the growth outlook, which is now basically slowed down.
So you use the word recession. I was going to use the word protectionism. So let's do that. Are we, first of all, perhaps you could explain what protectionism is, and if it is something that we should be looking out for or thinking about?
Most certainly. So what is protectionism? Protection is basically a trade policy which tries to, as the name suggests, protect your own economy first, puts America in this instance first, by basically making sure that it's tougher for foreigners to compete with US companies within America. So basically the idea is that importing goods is quite expensive. You can't buy your stuff cheaply from China. So with that, I'd rather buy my stuff in America because that's more accessible, and that gives US companies the ability to sell their products locally again. And obviously the motivation from that, from the United States point of view, could in theory make sense because you are running the largest economy in the world. It's a very diversified, very strong economy, and it's very consumption-led. So you have by country mile the strongest market and the strongest consumer and the wealthiest consumer as well. So if any country can stomach this, then it would be the States. If you take that angle, fair enough, right? But the reality is that you are creating frictions, you're creating inefficiencies, which simply don't help. And the US economy would be way better off by actually keeping an open trade framework in place. For example, if you could just keep on importing all your cars from Mexico, like there would be no losers in that. There would just be winners. So the US can then basically get cheaper cars, the consumer can buy cheaper cars, and you know what? The workforce in the States can actually focus on not industrialized jobs, but on the tech jobs, which is way more important to them and where they excel and where there's actually an undersupply of workers. There's no big unemployment rate in the States, so you ask yourself, who's going to fill those jobs if you just create protectionism? It's not going to work.
Mm-hmm. I'm so glad you raised the phrase winners and losers, because I was just about to do that and say again, it feels like there's only losers in this conversation. So South Africa loses, the US consumer loses. It feels like we lose a little bit more, but okay. And so are we sitting tight for 3 years and waiting for a new president of the United States?
I hope not. Look, I think we can hopefully renegotiate those deals. Whether we achieve it or not, I don't know. The reality is we must, as a South African, we must be just realistic that while the United States are reasonably big in our world, we are tiny in their world, right? So it's up to our politicians now, and maybe to our businesses to pressure politicians to get them to strike a deal. I don't think that the United States will reach out. We don't have a strong enough relationship there. So it's for us to improve things. Just to put the numbers into context, though, we do have a lot of export from South Africa to the United States, but it just accounts for 7% of our exports. So it's not that much, if I may put it like that. So they are a large trade partner, but certainly not the largest. And at the same point in time, 40% of those 7% are completely exempt from any tariffs because of them being commodities, right? So basically, the proportion of trade which is really affected is roughly 4%, which is definitely not immaterial. But you can see the way markets react in a quite relaxed way that it's not going to be the end of the world either, to be honest. But yeah, tariffs are never good. We are taking some pain, so let's negotiate them away.
To wrap up our conversation, if you were to give one piece of advice to a board of trustees or to a management committee of a retirement fund or to an individual investor like myself, what would it be?
It would be to cut through the noise. Don't be worried about individual political events. The world is uncertain, but it has always been and it will always be. Position portfolios which are diversified across asset classes, across regions, which basically can stomach and weather any storm. And be risk cognizant, whether you are optimistic or pessimistic on capital markets, it doesn't matter too much. You need to have a tight risk management framework in place to make sure that there's no negative surprises, because the capital markets are always full of surprises for us. But it's quite possible. So stay with, like say, level-headed, build smart portfolios, cut through the noise, and that's exactly what we do at Prescient.
Bastian, on that great piece of sage advice, I will wrap it up for today because I know we've run out of time. So thank you very much for taking the time to talk to us at EBnet.Stream.
Thanks for having me on, Natalie. It was a pleasure.